Here we are in November. They haven't done anything. Do you think by the end of this year, do you think they're going to raise the interest rates?
I do think that for the second time in a decade, the Federal Reserve will raise the overnight interbank lending rate by 25 basis points. And I think they're going to do so not because of a huge surge in growth. Clearly, if you look at GDP growth, it's averaged 2% since 2010. The average for the first 3 months of this year is 1.7%. Year over year, it's 1.5% the last 4 quarters. So global growth on a global basis has been heading towards the flat line. And it's the same case in the United States. So they're not going to raise rates because of some growth scare. They're doing it because they promised over and over again that they're going to raise interest rates. They said they were going to do it 4 times in 2016. They ended up doing it 0 times so far. They passed once again on this past FOMC meeting because I assume, even though they claim to be apolitical, they passed on raising rates because of the election. And I think if Trump were to be elected, and this is not a political comment on my part, but clearly Wall Street, for some strange reason, wants Hillary Clinton. So that means that the market's going to fall, probably maybe 20 handles on the S&P 500 or more. And that means that they can no longer raise rates at all for 2016. But barring that, if we do have a Clinton presidency, you'll have 1 rate hike in 2016. And that'll be the second one, as I said, in the past decade. And that's solely because the Federal Reserve promised over and over again that the economy is healed, that the buildup of excess reserves and the printing of $3.7 trillion has saved the U.S. economy. And they want to now, albeit gradually, begin to raise interest rates. So I believe they'll be raising interest rates into a recession, but that'll be the surprise for the Federal Reserve.
Well, you just mentioned that you think they're going to be raising the rates into a recession. And when we look at all the economic indicators, we're looking at manufacturing, retail, corporate earnings, delinquency rates. I mean, you name it, we're seeing ISM manufacturing. When we look at all this, everything is in contraction right now. And many of the indicators are repeating themselves in what we saw back in 2008. So do you think we're in a recession already?
Well, to be completely exact, so the ISM publishes the servicing sector and the manufacturing sector. Neither one of them is in contraction currently, although albeit very, very anemic growth. But these are surveys. If you look at actual, I like to look at things like what you mentioned, and that's corporate tax payments. They are down year over year. So if you look at earnings, they are down. They've been down for 5 quarters in a row. And if FactSet has it correctly, their guess is that earnings growth will be about 1.6% for the 3rd quarter. So if we're not in an out-and-out recession, we're damn close. Let's just call it a flatlining economy. And the economy is being kept afloat by asset bubbles, the building and servicing of asset bubbles, which in turn is being supported by $200 billion of QE each and every month. And it's being supported by $12 trillion of negative interest rate yielding bonds, sovereign and corporate, around the world. And when that ends, when interest rates rise, and I wrote a book about it called The Coming Bond Market Collapse, as you pointed to at the introduction, when that condition ends, you can forget about whether, we won't have to debate, Dave, are we in a recession? When interest rates rise, and I'm talking about normalized, go back to, say, 7% on the 10-year note, you won't be in a recession, you'll be in a depression, and it'll be global, and asset bubbles will collapse like they have never collapsed before. Unfortunately, that will be the case, in my opinion.
So when the bond markets go, what can people expect? What would they see
Well, the first thing
to occur?
Well, the first thing you'll see, first of all, let me just say that bond prices have already fallen and yields have risen. They're an inverse relationship, as I'm sure your listeners are aware. That's already started to occur. So the 10-year bottomed out in the U.S. about 1.3%. It's up to 1.8% as of this recording of the interview. LIBOR, which is the cost of dollar loans abroad. And by the way, LIBOR, the cost of LIBOR, the LIBOR interest rate, affects trillions of dollars worth of mortgages and derivatives around the globe. That is up 200% year over year. Now, it's tough when you do percentages on low numbers, but from about 30 basis points to 90 basis points is a big move. And most importantly, Dave, the inexorable decline of bond yields is over. It's done. We have now the truth. The truth is that we're facing insolvent governments whose central bankers have inflation targets. And even these central bankers have become disenfranchised with the way they've pushed yields down to zero and below. And now they're all, and I'm talking about the ECB, the Bank of Japan, European Central Bank, the BOJ, and the Fed. They are all now, because there's a lot of this groupthink that the Keynesian groupthink that they all have adopted. They now all believe that they want yield curves to steepen. So what they've done now is they've altered their quantitative easing purchases, their purchases of bonds. They're buying much less bonds on the long end of the yield curve. So yields have risen already. And the Fed has stopped QE in October 2014. And as I said before, I think they're going to go to raise interest rates December 14th and probably to release a vow or a VAR to raise them 2 more times in 2017. So interest rates are already rising. What happens when interest rates rise? Well, you're going to see, first of all, a collapse of every bond proxy that has been in place since 2008. So there's been a massive surge in debt issuance and a massive surge into risk assets to replace what used to be real interest rate returns after taxes. So you used to buy a bond at, say, 10-year note at 7% or 4% or whatever, mid-single digits. And after taxes and after inflation, you got a couple of percentage points in real interest rate return. Well, that went away in the end of 2008. You had nominal returns of zero, and after you deduct taxes and inflation from zero, you're going to get a negative yield. So what do? I buy REITs, I buy municipal bonds, I buy mortgage-backed securities, I buy collateralized loans, I buy stocks, I buy junk bonds. There's been a massive amount of issuance of corporate debt and all those things I just mentioned, and everybody's kind of hidden in these bond proxies. So when, by definition, if I just said that bond yields rise and bond prices are falling on the sovereign level, everything else collapses along with it. And when fixed income collapses on the sovereign level and fixed income proxies collapse because of the sovereign bond market collapses, you could also throw the stock market in there too. Because how many people bought Procter & Gamble and Johnson & Johnson at, massive PE multiples totally out of historic context because they wanted to grab yield. So everything is going to go down. That includes mortgage-backed securities and real estate prices. Everything is going to be collapsing concurrently and concomitantly on a global basis.
For the everyday person on the street, what are they going to experience? Those people that have, their pensions, those people who are retired, those people who have their jobs, what are they going to experience?
Well, they're in big trouble for the third time since the year 2000. They're going to be in deep doo-doo because these pension plans have been forced into risk assets. They couldn't get a return. They promised their retirees that they're going to earn 8% per annum. Well, you'll have to tell me what bond you can possibly buy that returns 8%. There isn't any, really, unless you want to buy, maybe a Zimbabwe bond. So they don't do that. It's not in their charter. So they've been buying stocks. And as of today, the stock market's up 2% for this year. But that's been the case since, basically since QE ended in October 2014, the stock market's gone nowhere. So what happens to these pension plans? They're all going to become insolvent. So what we're going to end up with, I think, this is my opinion, is that central bankers are going to slowly stop. They've realized that they cannot do QE forever. And they're going to try to, at least on the part of the Federal Reserve primarily, try to normalize interest rates. It's going to blow up in their face. It's going to backfire in a huge way. And you're going to have a massive correction. It's going to run concurrently with a recession. There really isn't anything the central bankers can do after that except then adopt helicopter money. So basically the genesis of Pento portfolio strategies was to model the difference between inflation and deflation, the difference between real interest rates that are negative and the dollar falling, and the difference between when real interest rates are rising and the dollar is rising. If you can get that investment spectrum correctly, if you get that right, then you'll be able to invest during times when we're deflating and during times when we're inflating. And you better have that right, because there's going to be another massive collapse in equity securities prices across the globe. And I try to profit from that. And then when everything shakes out and they do adopt this helicopter money. And let me just take maybe 30 seconds to explain helicopter money. What does it really mean, helicopter money? Well, you say, well, haven't they been doing that already? Well, not really. Right now, in most cases, the central bankers are going through the banking system to increase the money supply. So basically, they're just creating excess reserves for banks to loan. Well, there isn't any demand for these loans because people are debt disabled. The consumer hasn't really deleveraged. They have a record amount of debt, $14.1 trillion. Don't believe any of the malarkey you hear. I'll give you the truth. The consumers have not deleveraged. They have a record amount of debt in nominal terms. There has been some deleveraging if you put that as a percentage of the economy or as a percentage of income, but only on the margin. Record levels of debt nominally and near record levels of debt in those ratios. So, and corporations are the same thing. So there's a record amount, and sovereigns are even worse. So there's record amount of debt out there. So there's no demand for this money. So what's going to happen, instead of, and this is what I mean by helicopter money, instead of going through the banking system, they're going to start sending checks to people. They're going to probably outlaw money, physical currency, and just send you electronic deposits into directly from central banker to the individual, or from the central bank to the government directly. Forget about the banking system. So there's no excess reserves anymore. There's just a government that spends and a central bank that prints. That's where we're headed. And then you're in for a real intractable inflationary battle worldwide. So do you want to invest accordingly? Do you want to keep a static investment portfolio during those dynamics? You're more than welcome to do that, but you're not going to do very well. Or do you want to try to model that and make money from it? That's what I do.
With this helicopter money, is this going to be a one-off type of thing, or is this going to continue? And how much possibly can they hand out to the public?
Well, let me answer the former question first. One-off doesn't really make any difference. I mean, if I told you that the government was going to send $1,000 to everybody, that doesn't help you. I mean, it's going to be something that's going to be protracted in nature. So that answers the first question. And the second question you asked me is if there's any limit. There's no limit to how much. Let me ask you, how many digits can a central banker print on a computer screen?
But isn't this money going to be loaned to the government, or how do they count this as? Is it a loan? Is it?
No, Dave. Helicopter money, by its definition, the way I define it, and true helicopter money, you got to think Zimbabwe, Hungarian Pento, Weimar Germany. So you have a government that spends money and a central bank that just hands them buys it. So the government runs massive deficits. They issue debt, and the central bank buys it. That's it. End of the story. They do it by fiat, by decree, without any saving. It's not a savings and investment dynamic. They just enter electronic digits into a computer and hit the send button. Treasuries are purchased, and now the money's there. And now the government can the government can cut taxes. The government can spend money. They can build bridges to nowhere on every single street corner if they wanted to. They can pay people to empty the ocean onto the beach. That's what I think we're headed.
But doesn't the amount of debt then go up? Because really, Of
course it does.
And then the taxpayers, they're still, responsible for all of this.
Well,
are they really receiving
inflation? No, they're just receiving inflation. You'll get massive, intractable hyperinflation. The taxpayer's not on the hook. The central banks are on the hook, and that means is that the taxpayer will be paying instead of honestly through tax receipts, they'll be paying through inflation. There's no free. Basically, what I'm saying, there's no free lunch. There's nothing magical that's going to happen. So if you print money by fiat without savings, without investment, you're going to have some reaction. For every action, there's an equal and opposite reaction. It's a law of dynamics. It's a law of physics. So this is what's going to happen. The escape valve there is going to be massive, intractable inflation. That's where I think we're headed in the long run. Doesn't mean we're going to get there right away, and there's going to be lots of fits and starts. That's why it's important to model the dynamics as they change.
So there are a few people out there talking about transitioning into a new currency and devaluing the dollar. And of course, that would be hyperinflation because as the dollar devalues, the prices are going to be going up. Have you heard anything about a new currency headed our way, a worldwide type of currency?
Well, I mean, I don't know if you're referring to the special drawing rights, but there is a new currency out there. It's called gold. I mean, it's not new. It's been around for 5,000 years. It's a new currency. Oh, I just discovered it. And there are companies, and one of them I invested in personally. So, just full disclosure, I own it personally, called Gold Money. They have made it very easy for people to escape the entire fiat currency regime worldwide. You could store your money in a Brinks vault in gold for free, and you can spend that gold using a credit card. You also can transfer gold person to person or business to business in many cases. So you can use a real. This is eventually what's going to happen, Dave. People are going to eschew and completely reject on moral grounds fiat currencies, and they are going to return to honest, real money, real savings, and real investment. It'd be a wonderful improvement for the world. There won't be any huge trenchant gap between the ultra rich and the incredibly poor. There'll be a viable middle class. The economy will be real, without asset bubbles, stable inflation, stable currency. This is all wonderful news in the long run. That's where we want to get. Unfortunately, the powers that be have set us up for a catastrophic collapse along the way.
What is your time frame? When do you think this will fall apart? I mean, you don't have to give it an exact date and time, but I mean, are we looking at the end of this year? Do you think it's going to happen next year?
Well, let me walk you through real quick. So we already are now seeing the change in central bank philosophy. You're already seeing interest rates that have started to rise. I think the recession, which is the catalyst for all this, is nigh. It's at the door. And once that occurs, there's nothing the central bank can do except watch asset prices collapse. And that'll probably happen in 2017. I can't guarantee it, but it seems to me completely logical that the Fed cannot raise interest rates 3 more times without absolutely creating a recession that becomes manifest to everyone, even to them, sometime in 2017. So you'll have an inverted yield curve. We have a recession. Asset prices go down 50%, or at least very close to that, that causes the central bank, and not only the Fed, but all around the world, to switch to this helicopter money sometime right after that. So it's coming. It's not 10 years away. It's not next week, but it's here. It's at the door, and you should be preparing now.
Michael, thank you very much for being on the X22 Report Spotlight. I really appreciate it. Once again, can you tell people how to see your work and where to go for your website again?
Sure. The website is pentoport.com, and you can email me directly at mpento@pentoport.com. You can call the office here at 732-772-9500. And you can get a free trial to my podcast, which has a lot of this great data every week. You become a client. Actually, it's up to you, whatever you want to do. So we don't bite here. Just give us a call or reach out to us, and we'll try to take care of you.
All right. Thank you very much. Thanks for being on the Spotlight.
Thank you, Dave.